Now, if you think about it, we were talking about selling the call option, the May 19th. Let's go ahead back to May. We were talking about selling the May 101 or May 100. Let's go with the May 101. Make sure we're using the May 19th. The May 101 is somewhere between 174 and 181 right now. About $1.77, $1.78. If I were to round up and put a limit sell order on there, I'd put $1.80. When we were talking about doing a covered call, we were talking about $1.80 divided by $101. We're talking about making about 1.7% between now and May 19th. But if we're talking about $1.80 on 4130, we're talking about an instant increase now, 4.3%. Now that doesn't even include timing the purchase and the selling of the leap in the stock and the call. So in other words, we like to, if we're in a nice channel, we like to try to purchase our symbols, our leaps, towards the bottom of the channels. And you can purchase the leaps at any time. You don't have a certain timing. And then we like to sell our calls within 1 or 2 weeks of the next month. So we just had on April 21st, the end of the April series. So this week or last week, we would have wanted to try to sell the call. In fact, if we would have purchased our leaps, even over here in the middle of April at the low, this would have been a perfect time to be selling our call option right before it starts to decay back down. So when you start to put in the actual timing of these trades, we start to easily make our 6% protocol. In fact, most of the folks this past couple of months have been pulling 10, 12% on their portfolios. Using our money management and making sure that we're not putting ourselves into too much risk, we find that we put ourselves into about 3 or 4 different positions per month. Not 10 or 12. We don't have you in front of your computer monitoring 10 or 12 different positions. Usually you can figure out how to get yourself into about 3 or 4 different trades per month. And if you do find these sideways moving trades, it reduces the amount of research you have to do every month because you're just going to be evaluating the same position that you've been in for the previous months. Should I stay or should I go? How many with a show of hands have any kind of expertise with running some sort of business? Which do you think is better? And this is for all of you, not just for the business owners, but the business owners should get this right. Which do you think is better? Trying to work with existing customers or trying to find new customers? Who thinks existing customers are the way to go? Who thinks no way? I'd rather always go looking for new customers. Exactly. So the scoop is we're looking for existing customers. That's why it applies exactly to stocks as well. Would you rather be always researching new candidates to trade against, or would you rather be working with the candidates you've already been following and intimate with? I'm all about low-hanging fruit and being lazy. So I want to put it out there that the 6% protocol is an awesome program, and especially when you start doing these variants. So this is a diagonal. Oh, I apologize. I have about, I think Dan gave me 7 more minutes. I have until 12:10 Eastern time. So here's the scoop. Somebody said, well, what do you do about what you talked about in the beginning? You talked about the unlimited risk on covered calls. So we have different strategies, and I actually have a sample portfolio where we've had stocks go against us. It all comes down to money management. And the money management tells you, what do you do with your losers? Somebody's dog is in the background. Got to mute yourself out. Woof, woof. All right. So the scoop is when you start to build in a lot of extra profit, when you start to build in a lot of extra profit because you're using a lower cost basis like the LEAP, you can now use what's called protective puts, which limits your risk considerably. So a protective put, if you were looking at the profit and loss diagram, it would basically put a floor as to how much you could lose. That means your return on risk goes through the roof. So we use a lot of protective puts. I don't have much time left, so I'm just going to give you in my notes here. Protective put, go a couple of time slots out. In other words, if we're selling the May call option for premium, let's use the put that's out in June, July, maybe even August. The reason is because you will be finding times where you might want to have the protective put more than others. And so what's nice about that is if you go out with an August protective put, say for instance it's around earnings season or it's around the time when dividends are released or something like that, you may want to put your protective put in place. After the fear is past, you may want to take it back. When you go a couple months out, maybe 3 months out, 3 time frames out, you'll be able to sell that put back and recover a good portion of the value you paid for it. It's a lot different than, for instance, the insurance we get on our house, where they give you like a 30-day period where you have to have the insurance before they'll actually cover you. With the put protection, the put insurance, we can add it and subtract it whenever we want and only pay for it on a per-use basis. So we talk about in the 6% protocol the selective uses of the protective put. We also like to have strategies where we put automatic trading on the underlying symbol should the proverbial poop hit the fan, or if it was Dan, our host, he'd use a couple of other 4-letter explicatives, which we all love. We would automatically get out of the underlying symbol. And yes, the broker would then do a margin requirement, but we would have the cash in our account to cover that. And in our leisure, we can come back and buy back for almost nothing. Because if we actually did go down as low as we had to, that call that we sold, we would be able to buy it back for like pennies, whatever the market maker would want to sell it to us for. So those are some different strategies. I wish I had more time to cover those, but come join me at the 6% protocol.